What do you mean by lease? What is lease? I don't want to dwell too much on all this, but let me just give a brief a brief explanation of what lease, hire purchase, so that you have understanding of where we are going. Now, anytime a company wants to acquire non-current asset like a land, building, motor vehicle, plant and equipment, and the finance required is not readily available. So one option that the company has is to either lease the assets or purchase the asset through hire purchase agreements. Okay. Or another option is for the company to borrow loan. Okay, approach the bank and borrow loan to go and purchase the assets. Now, lease, for example, lease hire purchase, they are sources of medium-term financing. Okay, you have done sorts of finance. You have short-term financing. You have mid-term financing. You also have long-term financing. All right. So lease is one of those. Lease and hire purchase is one of the sources of finance for an organization. So when a company wants to purchase non-current assets and the capital required is not readily available, so the company can lease the assets. Now, when that happens, there will be a kind of agreement between the owner of the assets, which is the lessor, or you can say a landlord, and the user of the asset. The user of this asset is a lessee or tenant, however whichever way you want to look at it, whereby the contract agreements will dictate the responsibility of both parties, all right, both the landlord and the tenant. So to say, okay, these assets you want to lease from me, all right, these assets you want to lease from me. These are the rules. These are the do's. These are the don'ts of the asset, the pros and cons of the asset that you want to lease. It will be expressly stated in the lease agreement. Okay, it will be expressly stated the responsibility of both parties. Everything will be there complete. The amount for the assets, the interest, whatever, if there's going to be any, of course, the interest on the assets, and not only that, the specified future dates that the lease period will cover. Not only that, there will be a kind of a consideration that the lessee is going to pay to the lessor for the usage of the asset. So that is what lease is all about. So when you put it in the right perspective, lease can be said to be a contractual agreement between two parties, whereby one of the parties will grant the use of the leased asset to another party for a specified future date at a consideration. All right. If you define lease without mentioning future dates and the consideration, that in fact, even the lease asset itself, those three items must be there. You need to talk about the lease asset. When you want to define lease, you have to mention in your definition, you have to mention the leased assets, the specified future dates, and then consideration. Those three items. Not only that, there must be a kind of contractual agreement between the two parties. All right. So, like I said, the lease is a means of financing the use of capital equipment. All right. It's a means of financing a capital assets. Let's call it that way. So the bottom line as far as the lease is concerned is that usage of the assets is more important than owning the assets. As a lessee, my concern is I just want to use that asset. I need that asset for whatever purpose. So I want to use the asset. I don't care whether I'll be the owner of the asset or not, but my primary concern is for me to use the asset. So usage is more important than ownership as far as lease is concerned. Now, basically, there are two types of lease. All right, there are two types of lease. We have the finance lease. We also have operating lease. Now, when you talk about finance lease, all right, the finance lease is a type of lease whereby the risk and reward of ownership incidental to the leased assets are substantially transferred to the lessee. All right, I repeat, the finance lease, which is also known as capital lease, is a type of lease whereby the risk and reward incidental to the leased assets are substantially transferred to the lessee. When you talk about risk and reward, for the part of the risk, when you talk about risk associated with the leased assets, the risk is all about the maintenance cost, the insurance, and the repair that the company is going to undertake in ensuring that the asset is in good working condition. All right, because those things will involve cost. The lessee will incur cost to maintain the asset. It will incur if the asset is breakdown or whatever. So there will be a repair cost to be incurred. Not only that, that asset will also need to be insured. All right, in order to minimize the risk. Okay, so these are the risk part of the lease. Then the second part, which is the reward. You know, we said that finance lease is a type of risk. I mean, it's a type of lease whereby the risk and reward incidental to the leased asset are substantially transferred to the lessee. So the other part, which is the reward to the lessee is the benefit that the lessee will enjoy for the usage of the asset. That is the reward part of it. Because again, it's the lessee that will be using the asset for whatever purpose. So as the lessee is enjoying the usage of the asset, then is reaping the reward for on the asset. Okay. So that is as per that. That is finance lease. Now, I will come back to the characteristics of the finance lease. But before that, let's talk about the operating lease. The operating lease is just opposite of finance lease. The operating lease is a type of lease whereby the risk and reward incidental to the leased assets remains with the lessor. Okay, the owner of the assets will keep everything. He'll be the one to be maintaining the asset. Whatever that has to do with the insurance, the maintenance cost, and the repair cost that will be incurred on the asset is the owner of the asset, is the lessor that will bear everything. So now, when you talk about operating lease, it doesn't cover the expected useful economic life of the asset. It's just for short term. All right, it's just for short term. I don't want to talk too much on this. However, let's go straight to the characteristics. Let me just mention what make finance lease to be different from operating lease. Okay. Now, when you talk about finance lease, we said that the risk and reward incidental to the leased assets are substantially transferred to the lessee. If you want to lease a property, for example, and you know that, okay, all the maintenance of the assets, including the insurance and the repair costs that will be incurred on the asset, everything will be borne by the lessee. Then something is telling you that this must be a finance lease, because there are times you are going to, in fact, you may even need other experts for you to be able to establish whether it's a finance lease or operating lease. So, because we have seen several situations whereby in practice, it's not a clear cut kind of to be able to decide whether it's a finance lease or operating lease. But these are some of the things that you need to consider that are going to take. These are the features or characteristics you need to take into consideration for you to now make a conclusion that, okay, it's a finance lease or it's an operating lease. So once you discover that the risk and reward of ownership will be transferred to the lessee, that means it's a finance lease. Not only that, for the lease period of the leased assets, once you can establish that the lease period will cover the economic useful life of the asset, okay, the economic useful life of the asset, like let's say for example 90% of the economic useful life of the asset, that means it's a finance lease. All right, so that at the end of the lease period, the asset will just have a minimum amount, okay, we just have a minimum amount to minimal amount and period for the asset to be finally disposed of. Now, that is for lease period. Then the accounting treatments, okay, the accounting treatments of finance lease is that both the asset and liability are recognized in the statement of financial position, because even though legally the lessee is not the owner of the assets, but because of the fact that the lessee will use most of the economic useful life of the assets will be enjoyed by the lessee, and that's why it is important or essential that the lessee will represent that, we account for that in his statement of financial position. Okay, then of course the insurance and maintenance costs, everything will be borne. The insurance and maintenance costs will be borne by the lessee. He is the one that will be responsible for that. Then economic substance. The economic substance of a finance lease is that the lessee has acquired an asset with finance from the lessor. That's the economic substance, even though legally the lessee has not acquired any asset. But because of the fact that the lessee will enjoy almost 90% of the assets, we use over almost 90% of the assets. That means it's as good as the lessee has purchased an asset, even though legally it hasn't. All right. So when you talk about economic substance, what we are trying to say is that the lessee has acquired an asset from the lessor. Okay. Then cancellation. Another feature of a finance lease is cancellation, which means that the finance lease cannot be cancelled. It cannot be cancelled. If the lessor decide to cancel it, then there must be a kind of compensation to be paid. Now, this compensation will be detailed in the contract agreement to say that, okay, neither of the party will be able to cancel this lease agreement. However, due to one reason or the other, if there's any of the party that decide to renege or to want to cancel this agreement, then this is the compensation that the party will pay to another party. So it will be expressly stated in the contract agreement, because if you don't put it in the contract, if you don't put it in the contract agreement, there may be some kind of argument. All right, there may be some kind of argument, or which can also lead to litigation. It can lead to litigation. Now, so what we are saying in essence is that as far as finance lease is concerned, it is non-cancelable. You cannot say you are not doing again. All right, because if you eventually cancel it, the lessor must, of course. What we are saying is that if it is the lessee that cancel it, then the lessor must be paid. All right, the lessor must be paid. Whichever of the party that renege is the party that will pay the other party. Then now, at the end of the useful life of this, at the end of the economic working life of these assets, the lessee can decide to buy the assets, asset outrightly at a very lower price, that a price that is lower than the fair value of the asset. Say, for example, if at the end of the useful life, the asset is worth, that kind of asset is worth 100,000 in the market. So the lessee can pay, like, let's say 70,000 naira or 80,000 naira. All right. So that's why we are saying the option to buy. The lessee has the option to purchase the asset at the price expected to be substantially lower than the fair value at the date of the option is exercisable. All right. That day, because it will be in the contract agreement too, that, okay, by so period in the future, by so time in the future, the lessee has the option to either purchase the asset at so price or we can return the asset to the lessor so that lessor can rent the asset out again to another party. Okay, so these are some of the features of a finance lease. Now, what are the characteristics of of an operating lease? We've mentioned some of it. Number one is that the risk and reward incidental to the leased asset remain with the lessor. Okay, so once you know that the lessor is the one that is doing the upkeep of the asset, is the one that is maintaining the asset, that means it's an operating lease. Not only that, the lease period of an operating lease is very short. Okay, it's a short term, unlike the finance lease that cover substantially the economic working life of the asset. But as far as operating lease is concerned, it's meant for short term. Okay, it's meant for short term, usually less than the useful life of the asset. If the useful life of the asset is 5 years, then this operating lease may be for 1 year or maximum 2 years. Okay. So, and then, of course, once you have leased it for that short-term period, then the lessor will have the opportunity of leasing it to another party subsequently to earn profits on the asset. Then the next one is accounting treatments. Okay, is accounting treatments. So operating lease is known as off-balance sheet item in the statement of financial position. Just show it on the face of your balance sheet. It's not recorded under any of the category in your statement of financial position, just an off-balance sheet record. I believe there's a little change based on the IFRS 17. There's a little change to that. However, when Mr. Wasir is taking you you know better. He will talk more on that. Then insurance and maintenance, we have talked about this. Okay, for the insurance and maintenance of the asset is the lessor that will bear everything. All right, it's the lessor that will be responsible for the insurance, maintenance, and the repair costs that will be incurred on the assets. Then the economic substance under operating lease is that the transaction is short-term rental of an asset. So it's the lessor has nothing to do, is not interested in the usage of the asset. He just wants to rent it out and then there's something in return as compensation. Then the last one is cancellation. As far as operating lease is concerned, the lessor can cancel it at any short notice. All right. Either party can cancel at any short notice. So it's not mandatory on any of the parties. It can be cancelled at any time. So these are some of the features for operating lease. So again, at this level, it is possible examiner can ask you all of this. That's initially I wanted to skip it and just move to the key points, what you really know, you really need. But again, examiner can ask you at this level under financial management. So please do well to go through them, understand what is lease, what are the types of lease, what are the characteristics of each types of lease. You need to know it. And there are other types of lease. Okay, so just go through it. Go through this material. You need to learn about sales and lease back. What do you mean by sales and lease back? What do you mean by leverage lease? What is conveyance lease? Please go through the material and have the understanding. Not only that, you also need to read about the advantages and disadvantages of lease. All right. So just have at a glance, go through it, summarize it, and so that you know that one is settled once and for all. So let's talk about hire purchase. The hire purchase is closely related to lease, but they are different. Okay, the hire purchase is also a source of medium-term financing. Okay, now as far as hire purchase is concerned, if a company wants to acquire an asset and then the full amount is not readily available, the company can approach hire purchase company that CEO, I want to purchase this motor vehicle, but I don't have the means. I don't have the means to buy the asset now. I want to be paying instrumentally. So there will be an agreement between the two parties, between the IRE and the IRR. The IRE, is the owner of the assets, while the IRR is the user of the assets. Where the two of them will agree, all right, between the owner and the user, they will agree such that the user must pay. One key feature of hire purchase is that a deposit must be made before the asset will leave the factory of the owner. Before you take the asset away, you must pay deposits as a user of the assets. Because if you don't pay deposit, certainly you cannot have access to that assets. So that's one of the key feature of hire purchase. Not only that, until the final installment after you have paid the deposit. So the balance that you have plus the interest, you are going to prorate it for the period of whatever, whenever you are going to make the full payment. Maybe it's for 3 years, depending on the agreement, whether it's for 3 years or 5 years. So they will now you prorate. I'm sorry, you divide it. So instrumentally, every year is the same amount you are going to be paying. So when you now finish paying the last installment, that is when you now become the owner of the assets. That's the difference between the two, between hire purchase and the lease. So hire purchase is a contractual agreement between two parties, that is the owner of the assets and the user of the assets, whereby one of the parties acquired an asset from the owner or from the another party through regular installment payments, and ownership is only transferred to the user until final installment is paid. So it is only when you make the final installment that the ownership will be transferred to the user of the assets. So the contractual agreements will specify the responsibility of both, will expressly specify the responsibility of both parties. How you because the owner of the asset will tell you, just like a landlord and tenant will tell you, this is how you must use the assets. Because in case you are unable to pay the final installment, they can take back the assets. So they don't want you to misuse the assets, and there should be rules. That should be rules for the usage of the asset. You can't just use it anyhow and say, okay, you are not buying again. No, that will not happen. All right. So the rules and responsibility, the contractual agreements will surely expressly state the responsibility of both parties. Now, what are the key features? I'll just mention what are the key features of hire purchase. One is that the rental payments are in installments over the period of the agreement. Okay, the rental payments, the annual rental payment that the user will pay to the owner in installment, in the form of installments. Every year is the same thing. Of course, the lease agreement will show the amount you are going to pay, that the amount that the user will be paying to the owner of the asset on a yearly basis or periodically. All right, it could be every 3 months, it could be every 6 months, it could be every year. All right, but it must be there in the agreement. Then the second characteristic that you need to consider as far as hire purchase is concerned is that each rental payment is considered as a charge for hiring the assets. This specifically means that if the hirer defaults on any payments, if the user defaults on any payments, the seller or the owner has the right to take back the assets. What we are saying is that once you don't meet up with installment payments, then the owner of the asset can has the right to take back the assets. So you can, and that's why you see this is very common among the commercial operators, commercial vehicle, commercial, what do you call them? All these you see Agbero, all those people in the garage that do transport and all of that, most of those vehicles that you see, most of them are through hire purchase. And in fact, at times we see the hire purchase company with their representative monitoring how they are using those assets. And if if the driver or the owner or the user of the motor vehicle has not paid or has default the payment, you see, then they'll be they'll be monitoring the guy. Once they can lay hands on it, so you just see that they collect the asset back. And that's why oftentimes those guys just be running away. At times they may not even go to their park. So because they have not meet up with the installment for that period. So running is trying to escape until they get the money so that they don't collect back the asset from them. But the bottom line, as if in fact, at times the owner of the asset may be praying that you default, so that the deposit that you have paid will be forgone, because you can't collect that deposit back again. Once you make that deposit, you cannot collect it back again. It will be there in the agreement. Okay, so this item number 2, what we are saying physically, technically, is that once the IRR is the user of the asset, defaults on any of the payments, then the owner has the right to take back the assets. All right. So not only that, the IRR, that is the user of the assets, cannot pledge, sell or mortgage the assets because he is not the owner. You can only do that if the final installment has been paid, because once you make the final installment, you become the owner of the asset. Thereafter, once you have made the final installment, then you can pledge the asset for anything. You can use the asset to borrow loan. You can sell the asset. You can also mortgage it. But until that is done, the user of the asset does not have the rights, okay, to pledge, sell, or mortgage the assets, because he is not the owner. Okay. Now, another point that you need to understand, another characteristic of future is that the IRR makes an initial deposit. I've already said it before. All right. Before before the asset will leave, before the user or the IRR will take the asset from the owner, you must pay initial deposits. You must pay the initial deposit. That initial deposit will also be stated in the agreement, in the hire purchase agreements, so that you know the exact amount that you are going to pay as a deposit. All right. So you can just go through it so that you have understanding. If you can memorize like 5 or more features of hire purchase, you are good. All right. Just go through them. So that is for that. Then, of course, the advantages as well as the disadvantages of hire purchase. They are all there. Just go through it. Now, where I really want us to discuss is economic method of financing an asset. Now, this is what we are saying. When a company wants to acquire an asset and the finance is not readily available, there are 3 options available. There are 3 options open to the company. The company can either purchase the asset through lease, can either lease the assets, purchase the asset through hire purchase, or borrow loan and buy the assets. Those are the 3 options available. However, when this happens, the most important thing is that if you want to purchase, let's say, for example, you want to purchase a motor vehicle, you know the cost of the motor vehicle, you know the cash flows that the asset is going to generate at the end of the period, at the end of throughout the useful life of that asset. Therefore, you need to first evaluate the financial viability of the asset, because you can't just go ahead as a company. You are not supposed to just go ahead and commit financial resources into buying an asset or into lease an asset or buy an asset through hire purchase. You need to first of all appraise the asset to know whether it is financially viable. All right. So once you have determined the financial viability of the asset, you can then decide, okay, now we know that this asset is viable. How are we going to finance it? Should we buy the assets outrightly? That is, even though we don't have the means now, can we borrow money from the bank? All right. If you borrow money, certainly you know you are going to pay interest. So can we borrow the money so that we can use the money to go and buy the asset? That's one option. Option two is that, okay, we don't want to borrow. Let's lease the asset. Then you approach a leasing company. We have an agreement, and then you can lease the asset. The third option is to purchase the assets through hire purchase. So you approach hire purchase company that, okay, you want to buy this asset as hire purchase. So the agreement will be entered to. All right. So these are the three methods of financing an asset. So like I said, you know, in the in in finance, there are core three decision areas in finance. One is investing decision, okay? Investing decision. Two is financing decision. Then three, dividend decision. These are the three core decision areas in finance. So now, what we have done the investing decision through capital budgeting, right? What we are discussing now is the financing. So you want to finance is as an aspect of financing. So you want to finance an asset. You want to finance an asset. How do you do it? How do you finance the asset? And we are now saying that there are three ways you can do this. You can finance the asset through outright acquisition. Okay, that is borrow and buy. You borrow money and buy the asset. You can finance the asset through lease or hire purchase. Each of them, there are things you must know. Now, if you want to buy the asset through, if you want to purchase the asset through outright acquisition, there are three variables that must be present in your calculation. Okay, so you want to determine the most economical method of financing the asset. The first item is outright acquisition. Outright acquisition means that you are going to borrow loan and then buy the assets. That is outright acquisition. Under this, what are you supposed to do? First thing first, when you want to determine the PV, of course, that is, you want to determine the NPV of outright acquisition, there are three variables that must be present in your calculation. One is the initial outlay of the asset. What is the cost of the asset? That one will be there. Not only that, you also need to consider tax saved on capital allowance. Then lastly, you must consider scrap value. These are the three line items that must be there anytime you want to determine outright acquisition. Before you talk about any method of financing, don't forget what I said. You need to evaluate the asset to know whether it is financially viable. It is only when the asset is financially viable that you can be talking about method of financing the assets. If the asset is not financially viable, that means you cannot commit your financial resources into buying the assets. So there will be no need for any of these methods. It is only when the asset is financially viable that you can be talking about this. So the second option is lease. If you want to lease the assets, what are the variables that must be present? What are the variables that must be present? One is the annual lease rental. You must consider the annual lease rental. This lease rental is the amount that the lessee will be paying to the lessor every year. All right. So then the second item that you are going to consider when you want to determine PV of cost under lease option is the tax saved on the lease rental. Now, this tax saved on lease rental, when you want to determine the present value, you have to be sure you have to be very careful, because depending on when tax is paid, if tax is paid in arrears, so it means that the tax saved on capital on the lease rental you are supposed to pay in year one are supposed to claim in year one will be claimed in the second year because tax is paid 1 year in arrears. Let's say, for example, this asset has 5 years life. Okay, the asset has 5 years life. So when I want to, if tax is paid 1 year in arrear, okay, tax is paid 1 year in arrears. So what that simply means is that the capital allowance, the tax saved on capital allowance you are supposed to claim, the tax saved you are supposed to claim on the lease renter in the first year will not be claimed until the second year. So in this case, it will extend by 1 more year. So you are going to do annuity factor of year 2 to 6 instead of year 1 to 5. You only do year 1 to 5 if tax is paid in the current year. But if tax is paid 1 year in arrears, you have to do annuity factor of year 2 to 6. That is if the useful life of the asset is for 5 years. So I just need to bring your attention to that. Now, majorly, under the lease option, these are the two line items that you are going to have when you want to determine the PV of cost. Like I said, the first one is the annual lease renter, and the second one is tax saved on the lease renter. So just multiply the company tax rates on the lease renter to get the tax saved. All right? You multiply company tax rates on the lease renter, which will give you the tax saved on lease renter. Now, this third one, which is tax saved on capital allowance, you will only consider tax saved on capital allowance if it is a finance lease, because under finance lease, the substance is that the lessee has purchased an asset, even though he's not legally the owner of the asset. So, and then you know that lessee will account for the asset in a statement of financial position. Therefore, it is only necessary or it is only essential that you determine tax saved on capital allowance. So you only do this if it is a finance lease. But if the question is silent, you are not told whether it's a finance lease or operating lease, then you are going to assume it is an operating lease. All right. If examiner wants you to calculate for finance lease to be specifically mentioned, but where the examiner is silent, you are going to assume it's an operating lease. So if it's an operating lease, you only consider the annual lease renter as well as the tax saved on the lease renter. You don't have anything to do on the tax saved on capital allowance. But if it's a finance lease, then you are going to consider the three of them: annual lease renter, tax saved on the lease renter, and then tax saved on capital allowance. So those are the things you need to consider under lease option. The last one is hire purchase option. Under hire purchase option, there are 5 items you must consider, or you can break it down into 4. The first thing that you are going to consider under hire purchase is the hire purchase payment. This hire purchase payment is divided into 2: the initial deposits as well as the hire purchase installments. Okay, hire purchase installments. So those are the things, those are the 2 items that make up the hire purchase payments. Now, the third item you are going to consider is the tax saved on hire purchase interest. Okay, you are going to calculate tax saved on hire purchase interest. How do you do this? You know, anything that has to do with tax saved, which means that you need to multiply company tax rate. So to get the tax saved on hire purchase interest, just multiply company tax rates. Okay, you multiply company tax rates on the hire purchase interest. Okay, the hire purchase interest will always be given to you. So just multiply the company tax rate on it. So that will give you the tax saved on hire purchase interest. Then the fourth item will be the tax saved on capital allowance. Okay. Again, to get it, you must have calculated your tax saved on capital allowance before you get to this point. But if not, just to get the tax saved on capital allowance, just multiply company tax rate on the capital allowance. Okay, you multiply company tax rate on capital allowance. So that will give you tax saved on capital allowance. We have done this under capital budgeting. Then the last item that must be present is the scrap value. So you only use scrap value if you are given. If you are not given scrap value, just ignore it. That means you only consider 4 items. I repeat, under hire purchase, there are 5 line items you must consider in your calculation of PV of cost. The first one is hire purchase deposits. The second one is hire purchase installment. The third one is tax saved on hire purchase interest. And the fourth line item will be tax saved on capital allowance. Then the last one is scrap value. You only consider scrap value if you are given. If not, just ignore it. All right. So at the end of the day, after you have evaluated the options available, the first option, outright acquisition. Second one, lease. The third option is hire purchase. So any of the method of financing that produce the lowest PV of cost will be the most economical method of financing the asset, because the objective of the company is to minimize cost. Okay? The objective is to minimize cost. So any option that produce the lowest PV of cost is the most economical method of financing the assets. All right. Now, the last area we are going to talk about before we begin calculation is whenever you want to, I told you, before you begin to talk about economical method of financing an asset, you must first of all evaluate the asset, whether it is financially viable. All those things, when you want to evaluate the asset, all those things that you normally do when you are calculating NPV, all those things that you normally do is the same thing you are going to do here. The initial cost of the assets, you must consider it. The cash receipts or benefits, this is your cash inflow, okay? This is the cash inflow that the asset will generate, right? Then any incremental fixed cost or specific fixed cost or attributable fixed costs associated with the asset, we also need to consider it. We check in the question, if you are given any working capital, you have to consider it. Is there any tax? Are you given tax liability that you need to pay? Then you consider tax liability. Any tax saved on capital allowance? So all those things that you normally do to calculate your NPV, all right, is what you are going to do here. Then, of course, the next item will then be the appropriate cost of capital. In this case, the appropriate cost of capital will be the company's WACC, all right? So use the company's weighted average cost of capital. Then the last one is the useful life. So this, of course, after you have confirmed that the asset is financially viable, you then begin to talk about method of financing the asset. Now, under the method of financing the assets, you don't use the company's weighted average cost of capital. Rather, you are going to use cost of borrowing, after tax cost of borrowing. I repeat, when determining the most economical method of financing the assets, you don't use company's weighted average cost of capital. Rather, you are supposed to use cost of borrowing, the interest rates that you are going to pay to borrow money, to borrow loan on the assets. Let's say, for example, you want to borrow loan to purchase an equipment and you are given interest rate of 10%. This 10% is the cost of borrowing. The 10% is the cost of borrowing. So this 10% will represent the before tax cost of borrowing. So you need to convert it to after tax by saying interest multiplied by 1 minus tax rate. So this will give you after tax. You already know this. We did it under cost of capital. All right. So you just determine the post-tax interest. So that post-tax interest is what you are going to use to discount the cash flow under each method of financing the assets. Under lease, under hire purchase, or under borrow to buy is the same after tax the cost of debt or cost of borrowing that you are going to use. So watch out for that. So what else do we need to talk about? Now, so like I said, you are expected to calculate PV of cost under each method of financing the assets. So any method that produces the lowest PV of cost will then be the most economical method of financing the assets. So that's basically what you need to do under lease versus hire purchase or under this topic. All right. So you can just go back to the material and read more all the things that we have been discussing. So just read more so that in a summarized form. But what is important is that for you to do well under this topic, you must master all these items that I mentioned to you. Under outright acquisition, what are the variables you should consider? These are the variables here. Okay. Under lease, what are the variables you must consider? We have discussed it. These are the variables that must be there. Then under hire purchase, you have to memorize it. All this line item, okay? All this line item, you have to memorize it under hire purchase. So when you know this is the starting point, you can just, you study this, close your book, then write it down by yourself. Oh, okay, under lease option, these are the line items I need to consider. Under hire purchase, these are the line items. Under outright acquisition, these are the line. Once you get it correctly, then every other thing is, there's nothing there. It's very straightforward. Okay? So that is as per that. Let me know if you have any question for me before we begin to solve question. Okay? Let's have illustration. Any question? If there's none, we'll go straight to calculation. Now we are going to solve just two illustrations. Let me see. This illustration number one is unique. It's unique. In this illustration number one, especially this requirement number B, whereby you are asked to produce a repayment schedule. How do you determine, how do you calculate, or how do you prepare loan amortization table? So because of that, we are going to solve this illustration number one. Then we have one more. Let's solve a question that will involve the three options of financing. All right. Let's have a question that will involve the three methods of financing. Okay, yes. Let's solve this illustration number 3, which is a chair PLC. Then, if you like, you can just go ahead and study more. How many do you have in this material? Okay, just those 3. Anyways, so if you have access to the golden book, there are about 5 or about 5 or 6 different question and answers there. So just go ahead and study all of them, have the others, because like I said, this is the first outing for financial management in ICAN. This is the first outing. So leave no stone unturned. Any question that you can lay your hand on, just solve it, look for solution, have the understanding, expose yourself to as many questions as possible so that you are well grounded, because we don't know. Nobody can predict with certainty the kind of question or the topic that ICAN will test on that day. This is the first exam that you want to write in financial management under ICAN. So just just read, expose yourself as wide as possible to gain more insight into each of the topic. Okay, so let's start with this illustration number 3. After that, then we'll go back to illustration number 1. Yes, I need one of you to read for us. Who is helping us to read?
Let me read, sir.
Okay, go ahead. Go ahead, Samuel.
Okay. Trias PLC has decided to install a new milling machine. The machine cost 20,000 naira, and it was estimated that it would have a useful life of 5 years with a trading value of 4,000 at the end of the 5th year. Additional cash profits from the machine will be 8,000 per annum for 5 years. A decision has now to be taken on the method of financing the project. three methods of finance are being considered. A. Purchase the machine for cash, utilizing bank loan facility on which the current rate of interest is 14% before tax. B. Lease the assets under an agreement which would entail payments of 4,800 naira at the end of each year for the next 5 years. C. Purchase the machine under a hire purchase agreement. This would require an initial deposit of 6,500 naira and payment of 4,400 naira per annum, and at the end of each for the next 5 years. The interest part of the payments for tax purpose would be 2,100 naira at the end of year 1, 1,800 naira, 1,400 naira, 1,000 naira and 700 naira at the end of year 2, 3, 4 and 5 respectively. The company's weighted average cost of capital is 12% after tax. The rate of corporation tax is 30%. If the machine is purchased, the company will be able to claim a written down allowance of 25% of the reducing balance per annum. You are required to advise the management on A. Whether to acquire the machine, B. The most economical method of financing, and C. Any other matters which should be considered before finally deciding which method of finance should be adopted.
All right, thank you very much, Samiat. Yes, that is the question. In the A part, whether you are told or not, that's the most important thing you need to do. You must evaluate the asset to know whether it is financially viable. That's your starting point. All right. After that, you can then determine the most economical method of financing the assets. So let's go straight to solving this question. I will stop sharing this and move to the working notes. So, solution to illustration number 3, page 78. Page 78. The name of the company is Chair PLC. So, examiner is asking you to determine whether the company should acquire the assets. You are required to advise whether the management, you are required to advise the management on whether to acquire the machine. All right. So in this case, we need to evaluate. We want to calculate NPVs. Number A, calculating net present value. Now, to calculate the NPV, you go back to the question. The formats you are going to use to compute your NPV will depend on the variables you are given. If you have multiple variables, then it's better for you to use the columnar format. If in the question you have cash inflow, you have cash outflow, you have inflation, sorry, you have taxation, you have working capital, you have scrap value. So when you have multiple variables, it's better for you to use the columnar format. So in this question, we have tax, we have scrap value and all of that. So even though we don't have working capital, but again, let's use the columnar format. The useful life of the asset is for 5 years. All right. Therefore, I will then do year 0, 1, 2, 3, 4, and then year 5. Like I said, all the things that you normally do to evaluate the machine, all the things that you normally do to compute your NPV are the stages that you are going to carry out. So the first item here will then be the cash inflow. In this question, the examiner has given you the cash profit. You are told in the question that additional cash profit from matching will be 8,000 naira per annum for 5 years. So which means that to arrive at the cash profit, so I will come here, cash profits, 8,000 naira per annum. Just repeat it. It's 8,000 naira per annum. Then, after cash profits, what else? Remember, to arrive at this cash profit, that means they have determined revenue, they have deducted variable costs, then they arrive at all those cash outflows have been considered before they arrive at the cash profit. The next item is that you are now told we have a scrap value of 4,000 naira at the end of the 5th year. So put it there, scrap value. Okay. Now, before we consider the scrap value, let's check out the tax liability, because when you make profits, you are supposed to pay tax. Okay. So according to the question, we are told that the company's weighted cost of capital is 12%. Corporation tax is 30%. So I would then come here, tax liability at 30%. I would then go back to the question again. When am I supposed to pay the tax? Is it in the current year or 1 year in arrears? You can see in this question, the examiner is silent. You are not told whether tax is paid in the current year or 1 year in arrears. That means you are going to assume tax will be paid in the year the profit is earned. Therefore, we need to multiply 30% on 8,000 for each year. So 30% of 8,000 should give us 2,400. So here will be 2,400, 2,400 each. 2,400. The last one, 2,400. That's the tax liability. Immediately after tax liability, you must consider tax saved on capital allowance. So tax saved. So we need to go and work out tax saved on capital allowance. Let's see, NPV is here. Each method of financing. So without going too far, let's calculate our tax saved. Let's calculate our tax saved here. So I can say tax saved so that we are not switching pages. So let's just use your tax saved on capital allowance. We have calculated capital allowance severally previously, so you know it already. So we can use primary school method to determine, so calculate our tax saved on capital allowance. The first item here will be year. Narration. The cost of the machine, then tax saved at the company tax rate of 30%. Okay, so in year 0, the cost of these assets is, how much is the cost of the machinery? We are told that the machinery is 20,000? I think we have it on the first paragraph. Yes, the machine costs 20,000 naira. That's the initial cost or initial outlay. So here is 20,000. So year 1, we are supposed to claim annual allowance. So I will then go back to the question, how are we going to claim our capital allowance on the assets? You are told that if the machine is purchased, the company will be able to claim a written down allowance of 25% on reducing balance, okay, per annum. So 25% is our capital allowance. Therefore, you bring out your calculator. 0.25 multiplied by 20,000 naira. That's 5,000 naira per annum for the first year. So when you minus, we have 15,000. This represents tax written down value at the end of year 1. Moving to year 2, annual allowance at 25% of the written down value. So 15,000 multiplied by 0.25, 3,750. 3,750 minus 15,000 minus 15,000, that will give you 11,250. So written down value at the end of year 2. Remember, this asset has 5 years life. So in year 3, annual allowance at 25% of 11,250 multiplied by 0.25, 2813. Please, you have to use your calculator at your end so that you follow the way we are doing it. The difference would then be plus 11,250. So 8,437. 8,437. This is the written down value at the end of year 3. Moving to year 4, annual allowance at 25% of 8,437. Okay, multiply by 0.25 equal 2,109. Please always confirm the number at your end so that we'll ensure that we are using the right number, the right figure. So the difference would then be minus 8,437. That's 6,328. 6,328. 6,328. So this is the tax written down value at the end of year 4. The final year you need to compare. Final year is year 5. You need to compare the written down value from the preceding year. You compare that with the sales proceed. All right. I would then say sales proceed or scrap value. According to the question, the scrap value in the 5th year, we are told that in the first paragraph, yes, trading value is the same thing as scrap value. So which is 4,000 naira at the end of the 5th year. So here will be 4,000. So the written down value is more than the sales proceed. That means a balancing allowance of 2,328. So this is a balancing allowance at the end of year 5. Now, to now get the tax saved, we are supposed to multiply company tax rates on the capital allowance for each year. Therefore, 5,000 naira multiplied by 0.3, that is 30%. Here is 1,500, 3,750 multiplied by 0.3, 1,125. Year 3, 2,813. 2,813 multiplied by 0.25. Is it 0.25 or 0.3? 0.25. 0.3. Let me, thank God I remember quickly. That's 844. 844. Year 4, 2,109 multiply by 0.3. 633. Then year 5, 2328. Multiply by 0.3.
Sorry,
698.
6328, not 2328.
You said 63.
28, not 2328. Okay, the balancing allowance, sorry.
Okay. All right. The balancing allowance is 2328. So you multiply 30% on that, it will give us 698. Okay. So that is that. Now that we have computed, it has saved. We can then go and please you are going to call the number from the first one is 15. So that saved. First one is 1,500. 11,250. Is it 844? 844. 633. Then 698. Let me confirm just to be sure. 844. Yes, correct. Okay. So the next item will then be the scrap value. The same format that you normally use to compute your NPV is the same thing you are following here, right? So scrap value is 4,000 at the end of the useful life. Is it 4,000 or 48? Let me confirm. Yes, 4,000 trading value. Then we are going to have the initial cost. That is the initial outlay of the machine, which is 20,000 naira in year 0. So if you have working capital, you consider working capital. But in this question, we are not given any working capital. So here will be 20,000. Then 8,000. So you'll be giving me the numbers now. Minus 2,400.
71.
7,100. Okay. Next one.
6,725.
6,725.
6,444.
6,424. 6,424.
6,444.
6,444. Okay.
6,233.
6,233.
10,298.
10,298. Okay, so that represents the net cash flow. After this, we need to discount it at the company cost of capital. And according to the question, the WACC of Chair PLC, we are told the WACC of Chair PLC is 12% after tax. So here is 12%. Year 0 is 1. So discount factor at 12% for year 1. 1.12 raised to power 1 minus. That's 0.893. Then for year 2, 1.1
797.
797. Year 3.
0.712.
Okay. Year 4.
0.636.
And then year 5.
0.567.
567. So we then get the PV for each year. Present value. Okay. Let me do for year 5. 10,298 multiplied by 0.567. That's 5839. Then year 4. 6233 multiplied by 0.636 equal 3964. Then year 3. 644 multiplied by 0.712 equal
4588.
4588. Year 2.
5360.
5360. Then year 1. 71.
6340.
Pardon?
6340.
6340. So we now get the NPV. You add up the positive present value. You minus the negative. What's the final answer?
This 6,091 positive
6091. Okay, so according to the requirements, examiner is asking you to advise the management on whether to acquire the machine. So since our NPV is positive, then the management should acquire the machine. So you can say the management should acquire the machine. Considering the positive net present value of 6,091 naira. Okay. Or you can say the acquisition of the machine is financially viable, considering the positive NPV of 6,091 naira. Therefore, the management should acquire the machine. However you want to put it, you are good. So that's number 1, number A requirement. Then number B requirements, B1, requirement B1. So the examiner is asking you that you should determine the most economical method of financing the machine. According to the question, there are 3 methods for A, B, C. The first one, you have to purchase the machine for cash, utilizing bank loan facility on which the current rate of interest is 14% before tax. That means you want to purchase the asset through outright acquisition, borrow to buy. All right. So under borrow to buy, what are you supposed to do? So quickly, let's go that. Option 1. Outright acquisition. That is, if the company wants to borrow loan and buy the assets, what will be the PV of cost? To do this, I told you there are 3 variables that you must consider. 1 is the initial cost of the assets. 2 is the tax saved on capital allowance. Then 3, scrap value, if any. So we have year 0, year 1, year 2, year 3, 4, and then year 5. So initial cost of the assets is 20,000 naira. Of course, that would be in year 0. Then tax saved on capital allowance. We have calculated tax saved. In the first year is 1,500. Second year is 1,125. Third year is 844. Year 4, tax saved on capital allowance is 633, then 698 in the final year. Then we also have scrap value. Scrap value is 4,000. So these are the 3 line items you are going to consider under borrow to buy. So here is 20,000, followed by 1,500. Take. Followed by 1,500. Let me write that. 1,500, 1,125, 844. No, now. Sorry. So here is 4,698. So here is the net cash flow. Then you discount this, discount factor. Remember what I told you. Under economic method of financing, the discount rate that you are going to use will be the after-tax cost of borrowing. So you need to go and calculate after-tax cost of borrowing. You cannot use the company's cost of capital. So, working number 2, post-tax, interest, or cost of borrowing. So to do this, you know that post-tax interest is always interest multiplied by 1 minus tax. So according to the question, we are told that the company can borrow at the current rate of interest of 14% before tax. So before tax cost of borrowing is 14%. So 14 into tax rate is 30%. So 1 minus 30%. So final answer, 14 multiplied by 0.7. 14 multiplied by 0.7. That's 9.8%. So you are going to use this after-tax cost of borrowing of 9.8% for all the three methods of financing. So 9.8% at 9.8. In year 0 is 1. For year 1, it will be 1.098 raised to power 1 minus equal, that's 0.911, 0.911. Then for year 2, 1.098 raised to power 2 minus equal, that's 0.829. Then for year 3, 1.098 raised to power 3 minus equal 0.755. Please, at your end, you must confirm these numbers to be sure that we are using the right figure. Then year 4, 1.098 raised to power 4 minus equal 0.688, 0.688. Then year 5, 1.098 raised to power 5 minus equal 0.627. So we now get the present value. Here is 20,000. Okay. Be giving me the numbers now. Are we quarreling? Let me do for final year. 4698 multiplied by 0.627. That's 2947. 2947. Give me for year 1 to 4.
For year 1, 1367.
1367. Year 2.
937.
937. Year 3.
637.
637.
637.
436.
436. So let's add up. Final answer, what do you have?
This one is supposed to be 933, not 937.
Year 2. Do you
That's
mean year 2?
yes, 933.
1125 multiplied by
Yeah.
0.829. 933, correct. It's 933. Okay.
Sorry, and year 5.
Pardon?
Year 5. Year 5 is supposed to be 2946, not 7.
Okay, 2946. That is 4698 multiplied by 0.627. Yeah, 2946. Error of mind.
Year
2946.
1.
What happened to year 1?
371.
You said it's 1371. 15 multiplied by 0.911. 1367 is correct. Year 1 is correct. Okay, so the final answer will then be equal to 2946 plus 436 plus 637 plus 933 plus 1367 equal, then minus 20,000.
Minus 13,681.
13,681. Here is
Negative.
13,681 negative. That's the PV of cost under outright acquisition. We then go to option 2. We use this one for our working. Okay, option 2. VII. Option 2. According to the question, the second option is to lease. You are told that the company can lease the machine under an agreement which would entail payment of 4,800 naira at the end of each year for the next 5 years. So the annual lease rental is 4,800 naira at the end of each year. Therefore, option 2, lease. And then you can see in that requirements, in that number B, examiner did not tell you whether it's a finance lease or operating lease. Since examiner is silent, then you are going to assume it's an operating lease. So in this case, we need 2 line items. One is the annual lease rental, then tax saved on the lease rental. Okay, so again, we have this one will not start from year 0. We have year 1, year 2, year 3, year 4, and then year 5. If I like, I can turn it, since I have only 2 cash flows, 2 line items. So if I like, I can turn it around the way I want, the way we normally do for NPV. All right. So in this case, I will create a column for year. I create a column for description of items, cash flow, then discount factor at 9.8%, then the present value. So year 1 to 5, annual lease rental. The lease rental, the annual lease rental you're supposed to pay is 4,800. All right, so I need to calculate annuity factor of year 1 to 5. Okay, at 9.8%. Remember, in this question, examiner did not tell us whether we should pay tax in the current year or 1 year in arrears. So since examiner is silent, then to now calculate the annuity factor, I would then say 1.098 raised to power 5 minus equal minus 1 equal divided by 0.098 equal 3.810. Annuity factor is 3.810. Of course, it's expected that every one of you know how to calculate annuity factor. We've done it severally in the past. So 4,800 annual lease rental multiplied by 3.810 equal 18,288. 18,288. That's the total lease rental that the lessee will pay. Then finally, we need to consider tax saved on lease rental. Year 1 to 5, tax saved on lease rental. Okay, to calculate tax saved, let me put it there. Let me put it just down. Tax saved on lease rental
Babe,
The tax
babe.
saved on lease rental is calculated as the lease rental multiplied by company tax rate. So the lease rental is 4,800. Company tax rate is 30%. Therefore, 4,800, the space I gave is too short. So 4,800 multiplied by 0.3, that is 1,440, 1,440. So that's the tax saved on the lease rentals. Here will be 1,440 multiplied by 3.810. Let me push this one down a little bit. Yeah, 1, 2, 5. Tax saved on lease rental. Okay. So in this case, 1,440 multiplied by 3.810 equal 5486. 5486. So final answer would then be 18,288 minus 5486 equal 12,802. 12,802. That's the P-bill of cost. That's the P-bill of cost under lease. So that's option 2. Option 3. Option 3, hire purchase. The machine can be acquired through hire purchase. Okay. Under hire purchase, you have multiple variables. You are going to have initial deposits, hire purchase installment, tax saved on hire purchase interest, tax saved on capital allowance, then scrap value. 5 line items. So it's better you use the columnar format. So starting from year 0, year 1, year 2, year 3, year 4, and then year 5. Year 0 means, for the hire purchase agreements, initially when you are when you want to purchase the asset, when you want to acquire the asset, at the beginning is when you are going to pay the installment. You are going to pay the annual, you are going to pay the initial deposit. Before you take away the asset, you have to pay the initial deposit. So it's at the beginning. So I would then come here, HP hire purchase deposits. I will then go back to the question. How much is HP deposits? Option number C, you are told that the company can purchase the machine under a hire purchase agreement. This will require an initial deposit of 6,500 naira and payment of 4,400 naira per annum at the end of each year, at the end of each of the next 5 years. The interest part of the payment for the tax purposes will be that and that. So deposit is 6,500. So deposit is at the beginning, which is year 0, 6,500. It's a cash outflow. The company is paying it. After HP deposit, then you have HP installments, hire purchase installments. We are told that the company will pay 4,400 annually. So it's a cash outflow. $4,400. After HP installment, we need to consider hire purchase tax saved on hire purchase interest. Tax saved on HP interest. Okay, so we need to go and work it out. we stop at working number 2, I think. Let me check. This is working number, so we stop at working number 3. This is 2. This one is 3. This is 3. Then number 4 now. Working number 4. So tax saved on HP interest. Okay. The same way you calculate tax saved on capital allowance. So to get the tax saved on HP interest, indicate the year, right? Then HP interest. Tax rates, tax at 30%. Then tax saved. Okay, year 1, year 2, year 3, year 4, then year 5. The interest, the HP interest for the first year, according to the question, is 2,100. The first one is 2,100, 1,800. Then year 3, HP interest, 1,400, 1,000, then 700. 1,400, 1,000, 700. So 30% of 2,100 multiplied by 0.3. That's 630. So this one is not even needed. Tax saved at 30%. Tax saved at 30%. So here is 630. Okay. Then 1,800 multiplied by 0.3 equal. What did I do?
540.
540. And the next one, 1,400 multiplied by 0.3. 1,400 multiplied by 0.3. 420. Okay, so that's that. Now that we have computed the HP interest, then we can go and post it. 630, 540. 630, 540, 420, 300, then 210. It's a saving. So then we consider tax saved on capital allowance. The first one is 1,500. You are saving 1,500. 1125. 844. 633. Then 698. The last one will be the scrap value. Scrap value is 4,000 at the final year. So you get the net cash flow. Okay. So here is 6,500. That's the net cash flow. So 440. 4,400 minus 933. That's 3,467 negative. 3,467 negative. Year 5. 4,4. 4,000 plus 698 plus 210 equal, then minus 44508 positive. Then 4400 minus 420 minus 844. That's minus 3136. Then 4400 negative plus 1264. Oh, sorry, error. I've done that one before. 4400 minus plus 1664, 1665. 27375 minus 2735 negative. Then for year one, minus 44 plus 630 plus 15. 2270 negative 2270. So then discount factor at 9.8%. We have done that before. Discount factor 0.911. Please be calling the discount factor for me. Here is 0.911. Then year two, what do you have?
0.829.
829. Year three,
0.755.
year four,
0.688.
and then year five.
0.627.
6, is it 5, 6,
627.
627?
627.
Are you sure? 627 or 52 something, 56 something? Is it?
627. 0.627.
Yes. My mind was on the first one of 12% we calculated before. So 0.627. Thank you. All right. 0.627. Then we get the present value. Here is 65. Yes. Give me the present value for year 5. 508 multiplied by 0.627.
2068. 68.
2068. 2068 negative.
2267.
2267.
2267.
Okay.
2368.
2368. Year 4.
2385.
2385. So you add up and then final answer, you less 319. That will give us the NPV of cost. — 65 plus 2068 plus
15269.
15
269.
269 negative. All right. That's the PV of cost under hire purchase. So we are done with the three of them. So we can then find the summary. Let's put our figures in a summary. Summary of results. Okay. Methods. Then PV of cost. The first method is borrow to buy, outright acquisition. Under outright acquisition, our PV of cost was
13681.
13681.
81.
Here is 13681.
Negative.
Yeah, that's why we say PV of cost. Then the second option is lease, which produced 12802. Then the third one is hire purchase. Hire purchase, we got 15, 6 something something, 269, 15269, 269. Therefore, any method that produces the lowest PV of cost is the most economical method of financing. Lease is the lowest. Therefore, examiner is asking you in the question to advise on the most economical method of financing the machine. So, from the table above, or from the calculation above, lease option produced the lowest PV of cost of 12,802 naira. Therefore, the machine should be leased. So that's that. That answers the question. We have one more illustration to go so that we can complete this in due time. Okay. So let's have one more illustration on this. I will stop sharing this and then move to the working notes. Sorry, the study material. Let's quickly have one more. Like I said, we are going to solve illustration number 1 that talk about repayment schedule. So I need one of you to read. Who is helping us to read Conjoint PLC? Illustration 1. Somebody should help us read.
Okay, I share it, sir.
Okay, go ahead, Amarachi.
But John PLC is in the business of manufacturing plastic products. The firm plans to diversify into another business line. It has the option of either buying or leasing additional machine to enable it meet the desired expansion. The machine can be acquired for 3.5 million naira, and it is expected to have 5 years useful life with an estimated 500,000 naira salvage value. This acquisition will be financed by a 22% bank loan, which is repayable in equal annual installments over a period of 5 years. This installment payment comprises both interest and a repayment of principal and is payable at the end of each year. Alternatively, the machine can be leased for 5 years with annual lease payment of 1 million naira payable at the end of each year. You are required to A. Advise the management of Presume PLC on the option to choose. Support your answer with relevant calculation. B. Assuming borrowing plan is adopted, produced a repayment schedule, preferably in tabular form.
All right, thank you very much, Amara. So that is the question. In the A requirement, you are to advise the management of Pension PLC on the option to choose. Support your answer with relevant calculation. Based on the scenario, there are two options available to Pension PLC. One is to acquire the machine at a cost of 3.5 million naira. Okay, then the company is expected to pay, all right, supposed to pay interest of 22% on the bank loan. The company will borrow a bank through a bank at an interest rate of 22%. That's option one. Option two is to lease. Alternatively, the machine can be leased for 5 years with annual lease payment of 1 million naira. So lease rental is 1 million naira. When you look at this question, we are not given tax rates. It means that we are not given tax rate and we are not given tax capital allowance rates. So since you are not given capital allowance rates, there will be nothing like tax saved on the lease renter. There will be nothing like tax saved on the lease renter. So because of time, what are you supposed to do the same thing that we have done under Chair PLC is the same thing we are going to do here. However, there are just for the outright acquisition, there will be two variables available to us. The first variable is the initial cost of the machine, which is 3.5 million. The second variable will be the scrap value of 500,000. In the question, we are not given tax saved. We don't have capital allowance. Therefore, we are not going to calculate tax saved on capital allowance. So at the end of the day, we get our figures and then we'll move on from there. Then we don't do the second option, which is lease payment. So let me stop sharing this and quickly move to the working notes. Okay. Solution. So illustration number 1. That is still on page 74 or 73. Let me confirm.
78.
Oh, okay, 78. Solution to illustration 1 on page 78. Thank you. Okay, then. So I would then say, is it requirement A? Yeah. Requirement A1. Option 1. Borrow to buy. That is outright acquisition. So because we have only 2 line items out of the 3 line items under borrow to buy, so normally the same way you do to calculate your NPV, create a column for year, description of item, cash flow, discount factor, So, and in the question, we are not given company tax rates. Since you are not given company tax rates, then it means that the interest rate of 22% will represent your after-tax cost of debt. So that's that. So here will be 22%. Then PV. All right. So year zero, the initial cost of the machine is 3.5 million naira. Multiplied by 1, 3.5 million. Then there is no tax saved on capital allowance since you are not given capital allowance rates. So the second cash flow here will be the scrap value. Either the examiner call it scrap value or trading value, salvage value. It was called salvage value. So use the name the examiner has used for you, salvage value, 500,000 naira. It's a cash inflow. So I need to calculate discount factor for year 5 at 22%. So 1.22 raised to power 5 minus equal, that's 0.370, 0.370, 0.37 multiplied by 500,000. That's 185,000 naira. Then you now get your PV of cost. Okay. So in this case, 3.5 million negative minus 185,000.
3315.
3315. 3,315,000 naira negative. That's the PV of cost. That's the PV of cost. Okay. Then the second option is higher purchase lease. Option high. Option 2, lease. So again, since in this question, you are not given company tax rates, therefore you only have one line item, which is the annual lease rental. So we don't have tax saved on the lease rental, so you ignore that. So in this case, what am I supposed to do? I'm going to use formula. If you use table, you're still going to get the same answer, but that one will be longer. Just use formula and get your answer. So to do this, since the lease rental, annual lease rental, okay, annual lease rental is equal to 1 million naira. All right. And then the useful life of this machine is for 5 years. So in that case, I will just use a formula. So the PV of cost under this will then be PV will be equal to the cash flow multiplied by annuity factor of year 1 to 5 multiplied by 1 minus, let me do it this way, 1 minus 1 plus R raised to power, let me increase this one, raised to power minus n, then divided by r. Okay, so that's the formula. So I would then say PV equal to the cash flow is 1 million naira. That's the annual lease rental. So multiply by 1 minus the cost of the interest rate is 22%, so 1.22. The useful life of this machine is 5 years, raised to power minus 5, right? Then divided by 0.22. So just use formula and get your answer once and for all. If you use table, so be it. So I will just say 1.22 raised to power 5 minus, sorry, I have something on the calculator before. So 1.22 raised to power 5 minus equal minus 1 equal divided by 0.22 equal. So my annuity factor. So in this case, let me close this one. Coming. So that I don't need to do working twice, I will just calculate my annuity factor. Here, my PV will then be equal to 1 million multiplied by annuity factor. I got 2 points. Let me just open this up. 2 points for my calculator. I got 2.863. 863. 63640. 640. Let me write it out first. So because I'm going to need that number. 636, 639, 639, and then 63, no, 863, 639, 762. Okay, 762. Is it up to 9? 1, 2, 3, 4. 1, 2, 3, 4. Yeah, so it's okay like that. 62. Yes, so it's okay like that. So by the time you now multiply, our PV of cost will then be equal to multiply by 1 million. Use calculator. Multiply by 1 million naira. That's 2363, 2863, 2863, then 640, 640, rounding. Okay, so PV of cost, remember this one is minus, so that would be negative. If I don't want to follow this route, if I want to use the table, it's still the same thing. Alternatively, so you can use table to say, you create a column for year, description of item, cash flow, discount factor at 22%, then PV, right? Because I'm going to need that annuity factor. That's why I have to use that method. So, yes, year 1 to 5, lease renter, which is 1 million naira. We have calculated annuity factor to be 2.8. If we restrict our number to 3 decimal place, that would be 2.864. So this will give us 2 million. Remember, this is a cash outflow. So that will be 2,864,000. All right, 2,864,000. Because we have rounded our number, our annuity factor to 2.864. But here we use almost the whole number. So that's what is causing the difference. All right. So you can just say 2,864,000. So whether you use the tabular method or you use formula, you are still going to get the same answer. Now, examiner is asking you to advise which of the options to use to purchase the machine. Of course, lease produce a lower PV of cost. Therefore, the machine should be leased. All right, the machine should be leased. Examiner is asking you to advise the management of Conjoint PLC on the option to choose. All right, so the management, or you can say lease option, lease option produced a PV of cost of 2,864,000. Is it 864? Yeah. 864,000. 864,000. Why the outright acquisition produced a PV of cost of 3,315,000. Hence, or therefore, the machine should be leased. Machine should be leased, considering the lower PV of cost. So that answers number A. Quickly, let's do number B requirements. Now, in this number B, you are to assume borrowing plan is adopted. Produce a repayment schedule, preferably in tabular form. You must know how to interpret a question. You want to produce a repayment schedule. A repayment schedule is just like loan amortization schedule. You want to borrow 3.5 million naira. You want to produce a repayment schedule. Every year, you are going to be paying back the loan plus the interest. So the loan plus interest will give you you are going to have a kind of installment you are going to be paying on a yearly basis. So for the next 5 years. So you want to show what is the opening balance when you start paying the loan at the year 0, in year 1, what is the interest payments, what's the installments you are going to pay, what's the principal repayment, how much have you repaid from the loan that you borrow, what is the balance at the end of the period. So that's what the examiner is asking, so such that at the end of the 5th year would have paid back the entire loan. So you want to know how much are you going to be paying for every year, so that at the end of the payment period, you would have paid the entire loan that you have borrowed. So that is what is called loan amortization table or loan repayment schedule. Now, there is a format you are supposed to use to do this. Under this format, I can create 4 or 5 columns. Whichever way you want to do it, you are still going to get the same answer. But that notwithstanding, because of time, let me just use one for you. Number B, loan repayment schedule. So to do this, the first item will be the year. The first column will be for the year. Then we have opening balance. Opening balance. After opening balance, you need to consider interest payments. So interest is at 22%. Okay. Then annual installments. Annual, what's wrong? Annual installments. If you like, you can introduce additional column for principal repayments. You want to know from the loan that you have borrowed, how much are you paying on a yearly basis? How much are you repaying? Then you are going to have a closing balance every year. So let me give you, let's say this is A, this is B, this is C. Then D will be equal to C minus B. Then closing balance will be A, which is E, will be equal to A plus B minus C. All right. So year 1, year 2, year 3, year 4, and then year 5. So at the end of the 5th year, you would have recovered the entire loan, would have paid back the entire loan, such that at the final year, the closing balance will be equal to 0 or close to 0 because of rounding error. Okay? Let me complete the table first. All right. The interest, opening balance, column for year. Okay, so now the opening balance is 3.5 million naira. Here will be 3.5 million. Now, the interest you are going to pay on the 3.5 million is at 22%. So 0.22 multiplied by 3.5 million.
770,000.
770,000 is the interest in the first year. Then we need to go and calculate annual installments. So annual installments. So installments or loan repayments. Let me just put installments. Will then be equal to the loan divided by annuity factor. The loan amount divided by annuity factor. That will give you the installments. The loan is 3.5 million. Then the annuity factor, we have computed 2.863, 634. Let me see. Let me check again. We have it up there. Yes, 2.863639762. Please, at this stage, you must ensure that you are picking don't round your number, because if you round your number, you are not going to get to the actual, the closest figure that you are supposed to get, 863. What's wrong with you? 863, 639. Then 72, I think. Let me confirm. No, that'll be 72. Is it 672? 639, 762. 762. So like I said, in your calculator, you remember these 2.6 3,639,762 is something is what we have in our calculator. So this will now give us the annual installment that we're supposed to pay. So in this case, 3,500 3.5 divided by 2.863,639,762. That will give us 1 million. Annual installment is 1,222,221. Let me confirm my calculator. 22221. That's it. So this is the annual installments. So I will then come here 1,222,221. Repeat it. Every year is the same amount. It's constant. 1,222,221. 1,222,221. Okay. So at this point, we can then go ahead with our calculation. To now get the principal repayments out of the loan of 3.5, how much have you repaid? So that would be the annual installment of 1,222,221 minus the interest that you have paid, because your installment will include the principal that you have repaid plus the interest. So to now get the repayment, the principal repayment, just less the interest from the installments. So minus 770,000. So out of the 3.5 million naira, in the first year, you have repaid 452,221. Let me confirm. Yes, 221. So the balance at the end of the day will then be equal to, if you like, to get the balance, there are two ways you can do this. If you like, you can say the opening balance minus the principal repayment, that is 3.5 million minus 452,221. So we are going to get 3047. For my calculator, 3047,779,779. Okay, so that's the answer you are going to get. That's the closing balance. If I like, I can use the formula I've given to you, which is the principal, the opening balance plus the interest payments minus the installments. You are still going to get the same thing. That is 3,500. 3.5 million plus 770,000 equal, then minus 1,222,221. So we still have the same thing as 30,47,779. So your closing balance at the end of year one will become opening balance at the beginning of year two. So here will be 30,47,779. So we need to get interest on that. So 30,47,779 multiplied by 0.22. That will give us 670,511. 670,511. That's the interest. Then to now get the principal repayments, I will just minus what I have on my calculator. Minus 122,221. So that will give me principal repayment is 551. Here it will be 551. 551. I think 16. Let me confirm. 710. Let me confirm. Principal repayments, which is 122,221 minus 670, 511. All of you, that's 17. Yeah, 551, 17 is correct. You have left everything for me. Huh?
No, we are following you, sir.
Or you're on your own. You are following, you are not giving me number. All right. So the balance, to get the balance at the end of year 2. Okay, so I can say the principal repayment minus the closing minus opening balance at the beginning of year 2. So minus 30,47,779. So that will give me 2496. 2496 069. So that's the closing balance at the end of year 2, which will become opening balance at the beginning of year 3, 2496,069. Then I will multiply interest of 22% on that. Multiply by 0.22.
549,135.
Now you are talking. 549, 9 what? 549.
135.
135, 135. That's the interest for year 3. So to now get the principal repayments, I can just minus that. I will say 1,222,221 minus 549,135 equal principal repayment is 673,086. 0.6 or 0.83. Yeah, correct. So to now get the balance, I would minus what I have in my calculator. 673,086 minus the opening balance at the beginning of year 3, 24,96,069. So we have 1822, 1822, 983. All right, so that will be the closing balance at the end of year 3. So becoming opening balance 1822,983. So you multiply interest on that, multiply by 0.22. That
401.
produce 401
056.
056. Again, to now get the principal repayments, I will pick the annual installments, 221 minus the interest of 401,056. And we got 821,165. We have repaid in year 4. We have repaid 821, 165, 165. So the balance at the end of year 4 would then be 821,165 minus opening balance at the beginning of year 4, which is 1822,983. That's 1,000,000.
1001 818
1001
818.
818.
818. That's the closing balance. So becoming opening balance 001, then 818. I will multiply that with the interest of 22%, multiply by 0.22. That will give us
220 340.
220,
400. 220, 400.
220, 400. Then
220 340.
220, yeah,
400.
400, 400, yeah. So principal repayments. So that would be 1,222,1 minus 220, 400. That will give us 1,001,008 something, 821, I think. Let me
821.
confirm. Is it
Yes,
821?
821. Yes.
821. So to now get the closing balance at the end of year 5, so I can say my principal repayments of I can say opening balance of 1,01,818 naira, then minus 1,01,821 naira. So there's difference of 3 naira. So that's that. The difference, yeah, the difference is due to rounding error. Minus 3. Here is minus 3. So the difference is due to rounding. Ordinarily, the year 5 is supposed to be equal to 0. But because we rounded our number, so the difference, your rounding error should be less, should not be more than 1 digit. If it is more than 1 digit, that means when you are calculating your annuity factor, that means you restricted the number inappropriately. So that's what I said, that you can see instead of me to use 2.864 as my annuity factor, I have to leave what I have in my calculator. I make it nine digits so that my answer will be close to actual. Ordinarily, this minus 3 is supposed to be equal to 0 because at the end of the final year, we would have paid back the entire loan. All right. So that is that. This is what examiner asks you to do. You can see the opening balance for each year, the interest you are supposed to pay, the annual installments, the part of the principal sum that you have paid for each year, and the closing balance. So this is what examiner asks you to do, repayment schedule. Okay, and that's end of the question. Let me know if you have any question for me so that we can close the class. Like I told you earlier, on Wednesday, we are going to meet. We are going to do the special timetable for the public holiday, and on that day, I intend to take you on portfolio theory, and then if I have space, because other lecturer may want to benefit, use the opportunity also to recover part of the lost time. So, but if I have opportunity like this, like 6 hours, 3 hours for portfolio theory, another 3 hours for capital asset pricing model. That means we are going to keep 2 topics in a day, right? That's what I anticipate. We work towards it. All right. So again, next week Wednesday, this coming Wednesday, we are meeting. And it's going to be a combined class with other students in VI and then a solo. Okay. All right. Thank you guys for your time. I will see you on Wednesday by the grace of God. Good night, everyone.
Good night, sir.
Good night, sir. Thank you very much, sir.
You are
Good night,
welcome.
sir.
Mr. Victor,
Sir. Sir.
Yes,
you
sir.
are welcome. Yeah, Murphy Folua.
Good night,
Bye-bye.
sir.
Good
Yes,
night.
sir.
Good night, sir.
Your Excellency, good night.
Thank you for the
Okay.
link, sir. I appreciate
You're
you.
welcome. You're welcome, Victor.